Welcome to this explainer. Today, we're unpacking a brilliant, frankly massive wealth hack hidden right inside the Income Tax Act that could save you a huge amount of money. If you're sitting on highly appreciated assets, you're definitely going to want to pay close attention because what we're about to cover really changes the game on how you plan your financial exit strategy.
So think about your portfolio for a second. If you've recently cashed out of a startup, maybe sold off some inherited family gold, or finally liquidated a foreign asset or a commercial property, you're probably dreading the upcoming tax season. And for good reason. Realizing those massive gains usually comes with a very painful tax penalty that takes a big bite right out of your success.
And here's why. 12.5%. That's the standard long-term capital gains tax rate in India for non-equity assets and listed equities above the annual threshold. When you're dealing with lakhs or even crores in profit, that 12.5% can effortlessly wipe out a huge chunk of your hard-earned wealth. But what if I told you there's a perfectly legal way to bring that liability down to absolute zero? Okay, let's look at our roadmap. We'll cover the Section 54F secret, who and what qualifies, the strict timelines you need to follow, some real-world tax math, and finally, common myths plus the CGAS lifeline.
All right, Part 1. The Section 54F secret.
Now, you might already know about Section 54. That's strictly for when you sell a residential house to buy another residential house. But Section 54F, that's our secret weapon. This applies when you sell virtually any other long-term asset, like gold, shares, or land, and use those funds to buy a residential house.
So the absolutely crucial point here is that your tax exemption isn't about the gold or shares you're letting go of. It's all about the residential property you are acquiring in India. As long as you're converting an eligible long-term asset into a residential home, you're basically unlocking a massive tax shield.
Moving on to Part 2, who and what qualifies.
First up, who can actually use this? Well, if you're an individual taxpayer or a Hindu undivided family, an HUF, you are in luck. You are the exact target audience here. But if you operate as a company, an LLP, or a trust, unfortunately, this specific lifeline is off limits. It's designed strictly to help individuals and families convert their wealth into a home. And what can you sell? Honestly, a massive variety of assets. We're talking startup ESOPs, equity mutual funds, foreign stocks, or finally selling off that commercial shop you inherited. Even cryptocurrency, which is treated as a virtual digital asset, qualifies. Literally almost any capital asset except an existing residential house can trigger Section 54F.
Let's get into Section 3, strict timelines and rules.
Now, the tax department doesn't just hand out freebies, right? You have a very specific window. You can actually purchase the new house up to 1 year before you sell your asset, or you can buy it within 2 years after the sale. If you'd rather build a house from scratch, you get up to 3 years after the sale date to finish construction. Timing is absolutely everything here.
Plus, there are a few other strings attached. The asset you sold has to be considered long-term, which usually means held for over 24 months or 12 months for listed equities. The new house must be located in India. You also can't already own more than one residential house when you sell your asset. And super important, you can't just flip the new house. There's a strict 3-year lock-in period. Otherwise, the taxman reverses your exemption entirely. Time to look at the numbers in Part 4, Real-World Tax Math. Okay, this concept is absolutely vital. Unlike other tax sections where you only need to reinvest your profits, Section 54F demands that you reinvest your entire net sale proceeds to get a 100% tax break. If you don't invest the whole amount, you don't lose the benefit entirely, but you get what's called a proportionate exemption. Let me show you exactly what that looks like.
Take Rahul, a 42-year-old software engineer in Bengaluru. He sells unlisted startup shares for 80 lakh rupees. He then buys a flat for 70 lakh rupees. Because he only reinvested 70 lakh out of his total 80 lakh proceeds, our formula gives him a partial exemption. But check this out. He still permanently legally saves roughly 7.1 lakh rupees in capital gains taxes that he would have otherwise just handed over to the government. That's huge.
Now contrast that with Priya, an NRI living in Dubai. She sells foreign stocks for 1.2 crore rupees. She takes that entire 1.2 crore, actually she adds to it and spends 1.5 crore to buy a flat in Chennai. Because her invested amount is greater than her net proceeds, her Indian long-term capital gains tax is legally wiped out entirely, a full 100% exemption.
Finally, Part 5. Myths and the CGAS lifeline.
Listen, the absolute biggest mistake even seasoned investors make is thinking they only need to take their initial investment off the table and just reinvest the profit into a house. Not true. The reality of Section 54F is strict. The entire sale amount, your original cost plus the profit, has to be committed to the new property for total tax relief. Reinvest only the gain, and you're going to end up with a hefty tax bill on the rest.
But what if tax filing season is looming and you just haven't found that dream house yet? Enter the Capital Gains Account Scheme, or CGAS. It's basically a government-approved parking spot. You deposit your funds into a designated CGAS bank account before your tax deadline, and it essentially freezes the funds. This lets you provisionally claim the exemption while you comfortably continue your house hunting.
Let's bust a few final myths before we wrap up. Yes, NRIs are absolutely eligible, provided they follow FEMA rules and buy property in India. Second, that lock-in period before you can sell the new house, it's a strict 3 years, not 2. And lastly, just buying an empty plot of land won't save you a single rupee in tax, unless you actually build a residential house on it within that 3-year deadline.
You know, there's an estimated 8 to 12 lakh crore rupees in unrealized long-term capital gains just sitting in Indian households right now. It is truly staggering. It becomes so clear just how much wealth is trapped out of the fear of tax penalties simply because people don't fully understand the law and the incredible tools available to them.
Which brings us to one final huge question for you. What highly taxed assets are you needlessly holding on to just out of fear of the taxman? Now that you're in on the Section 54F secret, how is this going to change your next big move in the market? Think it over, run the numbers, and take control of your wealth.